Barangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Well, hello and welcome to the COB on this Friday afternoon. I'm Nadine Blaney, and it's really nice to be here with you to wrap the market and to wrap the week when let's just check, I think still have some green on the screen. Barely. We've been sort of up and down, a little bit of a volatile session here. 11 o'clock, things were looking really sweet, and then by 2 o'clock, hitting the peak, although we have seen some selling. Still a positive session, up by about 0.2%. And if I'm not mistaken, once we see the S&P ASX 200 close, we'll be up for the week. So that's sort of a relief to see after all of the selling. And, you know, I've had a number of conversations this week with folks who say that we will continue to see some selling, likely that this correction is not over. Of course, you know, we'll see. Only time will tell. Let's get across some of what we're talking about this week, and today particularly, shopping spree. We had the ACCC come out with its long-awaited report into the grocery sector here. And while there were some firm words for the grocery giants and about 20 recommendations, more bark than bite at the end of the day, and we'll see why in just a little bit. Iron ore worries, so iron ore miners are coming under a bit of pressure. We've got some concerns coming out of China, obviously, in terms of demand for steel. And Chalmers Hour, we've got the budget on tap for next week, so I'll chat with my special guest, Shane Oliver from AMP, about that one in just a tick. Let's get you across some of the sectors and the performances of the day today, and look no further than the consumer staples that helped lift this market higher. Interesting to see Endeavour Group riding on the coattails of Coles and Woolworths. I wish we had Metcash up there. Let me just check in on Metcash, because you know, the ACCC is talking about really starting to foster an environment that we can see smaller grocery stores and cooperative grocery stores take on some of the big players in the space. Metcash up a more muted 2.5%. Getting to the iron ore miners, there you go. We've got BHP and Rio Tinto higher, but Fortescue coming under pressure, down by close to 0.7%, and MinRes off by 2% to $22.83. The gold sector, some of these gold miners really hitting a record high today. Regis Resources up by 2.2%. Most of the smaller players likely responsible for that. And then you've got energy, which is looking pretty mixed here on the screen, but mostly positive. We saw the iron ore miners have a big leg up today, and that included the likes at one point of the Boss Energies of the world, Deep Yellow. Yeah, Deep Yellow is still up by 2.7%. We had results coming from Premier Investment. It says that it expects to return to declaring dividends at its full year result in September. Nine Entertainment confirmed it is in talks with property data group CoStar over that unsolicited bid for Domain, of which Nine is majority owner. Paladin says that its Langer Heinrich mine in Namibia is being impacted by unseasonably heavy rains. And Morgan Stanley is optimistic on CSL in anticipation of upbeat vaccine rates due to the severity of the current flu season. In the smaller end, Phoenix Resources surged as CZR Resources recommends the offer. And Breville has jumped. Citi is upbeat on the company's medium-term prospects. I do believe we have Shane Oliver from AMP standing by. Looking forward to this chat. Shane, nice to see you on this Friday afternoon. Mildly positive for the week here in Australia, but would it be a mistake to read too far into that considering the volatility that we've seen?
That's right. Look, markets never go in a straight line. I mean, rarely, like in 1987, you know, we fell 30-odd% in one day, but that's a very unusual situation. The reality is that normally markets go down for a bit. We had 3 or 4 weeks of falls. They'd become oversold technically. Investor sentiment had become very negative, which is positive from a contrarian point of view. And so we were set up for a little bit of a bounce, which is what we've seen here. I think top to bottom, we fell something like 9.4% to the low last Friday, I think it was. And since then, we've had a bounce of about 2%. So these things happen. It's obviously been helped in the last week because we haven't had new tariff announcements from Trump. He's kept quiet on that front, seems to be focusing on other things, chatting with Putin and so on regarding Ukraine. So that's what's helped the market. But I think it is too early to say that we've bottomed. There is more bad tariff news to come the week after next. Obviously, with the reciprocal tariffs, big risks around Australia being impacted there. But I think the bigger risk is that Europe and China get impacted more, and the trade war they're in with the US gets a lot worse, and that has an adverse impact on demand for our exports. So I think the risk is still on the downside in the near term. There are some positives out there, though. The Fed is still leaning dovish towards rate cuts eventually. Other central banks this week, the Swiss cut rates, the British weren't so optimistic on that front, but the broader trend is still towards lower interest rates globally, so that could provide some help at some point. But at this stage, I think it's still too early to say that markets are bottom.
Yeah, okay, so still premature because the biggest threat still remain tariffs, insofar as the damage that it could inflict on global growth? And if we do hear more rhetoric, and when this tariff reciprocation comes through, what is the size and scope of the falls that we could still be in for in terms of a correction for equities?
Yeah, I think it's all about tariffs and what's coming out of the US more broadly, signalling a huge change to the global environment as we know it. Alliances are being ripped up here. That on its own is causing big uncertainty, the treatment of Ukraine. Lots of noise around that. So it seems like the world, as I've known it for much of my career since the early 80s, is changing quite radically at the hands of Donald Trump. I think he's making a big mistake. Yeah, sure, we needed to fix things up, but not blow them up. And that is obviously creating a lot of consternation here. But central to all of that, of course, is the tariff. This idea that you can return the US to where it was at least pre-2001 when China entered the WTO, and maybe take us back to the 1950s. I think that stuff is all very nice. You dream about it at times, and everyone wants to watch retro movies, but trying to get back to that time is going to be nigh on impossible. And I think the turbulence that's going to be caused by trying to return production to the US is going to cause a lot of consternation, which will actually ultimately make Americans worse off, not better off. So I think this story has a long way to go. At some point, hopefully, 10% I don't think was enough to do it. But at some point, there'll be a backing down to some degree, a moderation coming out of the Trump camp, more focus on tax cuts, deregulation, those sorts of things, and that might help markets. But we've still got a way to go before we get to that point. And obviously, Australia is vulnerable in all of this. We're a small or a mid-sized open economy, very reliant on trade. If you have a escalation in tensions with China, what does that mean for Australia? It obviously means some uncertainty. So there's a lot of noise around all of this. And in some ways, as an economist, it gets you kind of worried because, the age of the economist is passing and we're moving to the age of the maybe the autocrat. Hopefully democracies prevail, but obviously the risks here have gone up.
Yeah, it certainly feels as if it, doesn't it? Look, Shane, leaving that aside, we have the budget next week. What are you expecting? I mean, we've got obviously some loose spending, likely, and then we've got the prospect of the election. So how is this all going to play out next week when we get the budget?
Well, whenever you talk about Australia, we have our issues here, but they're nothing like what goes on globally. And right behind me is beautiful sunshine, a nice day, nice afternoon in Sydney. So it's not all negative. On the budget, yes, we will see a lot of spending. We've already seen a lot of that this year, $35 billion plus in new spending announcements from the government in the run-up to the election. I think they assume the election would have been called by now, but obviously the budget will give them new opportunities to announce more spending. And on the one hand, that helps boost the economy. On the other hand, it does make the Reserve Bank's job harder, and it does, I guess, help cement in bigger budget deficits. So it does create some problems. But I think this budget will be a little bit different to other ones. It's a lot more political in nature, and that, of course, makes it a bit messier to look at. A lot of the stuff's already been announced because government thought that they would have called the election by now. They thought they would have called it 2 weeks ago, but the cyclone got in the way. So therefore, there's probably not going to be a lot of huge surprises in the budget. But I think the key will be extra spending. We're going to see a decade's high level of spending as a share of the economy. There's going to be ongoing reliance on bracket creep to eventually bring the budget back into balance, but that's probably going to be a decade or so away. Yesterday, I saw the Treasurer ruling out further tax cuts. It's not overly fantastic. The good news, though, is that there is this revenue windfall continuing. I reckon probably another $10 to $15 billion extra revenue compared to what the government was assuming back in December. So that will sort of limit how much the budget deficit numbers blow out by. And that extra revenue is coming from, obviously, bracket creep, lower than expected unemployment, higher than expected iron ore prices. And so that's a positive in all of this. But at the end of the day, this budget will be, as they often are in Australia, one day wonder. We'll then go back to focusing on what Donald Trump is doing, or in the previous years it was what was happening with inflation. So it's we have this obsession with budgets in Australia, but as investors we need to recognise, yes, they have an impact, but a day or so later we move on to other things.
Yeah, it's true. And one of the things that we'll be really paying attention to next week are the global PMIs. So how important are these, particularly in the United States, when we've heard from a Fed that at least has said that it will be sensitive to data? How did you read the Fed, and how will it be interpreting any signs of weakness in the data?
I think the key from the central banks right now is that they are very data dependent. They all talk about uncertainty at very high levels, mainly due to the tariffs. Whether it's the Bank of England, the Swiss, overnight, the Feds, all see a big increase in uncertainty. For the Fed, the environment's become less positive, weaker growth, higher inflation in the short term. I would have, if I was Powell, avoided reference to transitory, that dreaded term, transitory, back from 2022. And he's now saying that it was transitory. I guess when you look back through the history books, the inflation surge then was transitory, but at the time it went on for a lot longer than the use of the term implied. So that's probably not a good term to use. But I think the bottom line is that all these central banks will play it meeting by meeting. They'll be looking at the data very closely. And the reason the PMIs are important, I know it sounds like a silly piece of jargon that economists have dreamt up, but a PMI is a survey of purchasing managers in companies. So it's basically a company survey. Ask them how do they feel, happy, sad, whatever, and ask them questions about orders, employment plans, inflation, and so on. Now, the interesting thing recently is that overall they've been okay. They've been consistent with okay global growth. But we had weakness in Europe, to a lesser degree Japan, Australia. And the US was holding us up lately, starting with the February numbers, which of course coincided with Trump taking over. It's flipped to some degree. We've seen improvement outside of the US and the US deteriorating. So obviously investors will be looking to see whether that continues when those numbers come out on Monday. I think it's Monday morning Australian time, around about 9 a.m. They start to come in Australia, and then of course the rest of the world will come overnight. It's actually the major developed countries that comes out overnight. So they're certainly worth keeping an eye on, but they're a good barometer of how the global economy is going, and also give us a good guide to how US companies are holding together, given the uncertainty around the tariff. All
right, well, we'll talk about it next week, shall we? Shane, have a great weekend. Okay, Shane Oliver there from AMP. Thank you. All right, stocks of the day. Supermarkets, Woolworths, Coles, Metcash. We spoke with Adam Dawes from Shaw & Partners and Junbei Liu from TenCap.
There wouldn't be any real major disruption to that. They did say in some of the end of those statements that the prices might have to rise because we've got more compliance, or we're going to have to do more things. So it's probably not what the market wanted, or what investors wanted, or as well as then the shoppers wanted as well. I think inside of that, Woolies looks probably the best one placed. So Coles has had a really good run, but we've seen Woolies, getting a really good tick up there, and I think Woolies is probably the best placed to take advantage of that upward momentum, or that positive momentum that now the ACCC has come out and sort of given those recommendations.
And next year, consensus or analysts are expecting quite a lot of growth for these names. And when I speak to the analysts, many of them have mentioned that that probably is a little bit too bullish. Double-digit earnings growth come from both supermarkets in the next 12 months. It seems quite an aggressive assumption. Even if the competition that sort of abates. So I do think that they look a little bit more expensive. It's defensive in the current environment, but I think the earnings probably, especially in the terms of in Woolworths, there might be still a little bit of earnings downside, so the analysts need to bring their numbers down.
Welcome back, and we'll take a look at the market leaders after hearing their view on Coles and Woolworths. That's how much those shares are up today, close to 6% and 5.5% apiece. Premier looking good in the wake of its results. Codan has had a strong week. It's up by 3.9%. It did have a broker move on the, I think it was yesterday out, but still looking good today, as well as Boss Energy up at the top of the list, putting on close to 8% to $2.88. The laggards, though, there are the losers on each and every day, and look no further than Pro Medicus. Interesting. I'm not seeing any news, but it's down by about 7%. Liontown Resources down by 6%. Coronado Global Resources in the coal space. Liontown, by the way, had its price target cut by Canaccord Genuity. Coronado has seen its a little bit of a review from S&P rating, putting its credit rating to B, so that has hurt the company. Emerald Resources was out with the production update, down by 4%, and Pilbara talking about those problems coming through. Price target cut 23% to $3.50 per share. So that's PLS now. It used to be Pilbara. What's happening in the small to mid-cap space? You can see 7 West Media there, up by 6.6%. Flipping the page, and we've got Findy, after its raise, down by about 12% to $4.61. A little bit of profit taking coming through in the silver space as well. But I had a really great conversation earlier on with Thomas Atkinson from FX Evolution. He ran me through some charts. It's up online under the trade, if you look for the trade. And look, he's so good with those charts. He brought me a Telstra chart, a Linus chart, an ASX, an S&P chart, but also silver. So you want to check that out if you've got any time over the weekend. Tonight, we do have consumer confidence in the EU. Index is expected to be into negative territory again, which would indicate further pessimism. And we have some Fed speak. Interesting. FOMC member Williams. So we'll see if there's any meat to be put on the bones of that hold. Dovish hold, I'd say, that we saw this week. Next week, as we were just discussing with Shane, we get the global PMIs in Australia and the US, right around the world though. We have the federal budget. We'll be bringing you a budget special on the 26th from about 9:30. I know maybe all of you aren't going to be staying up and hanging out for the budget, but it does matter. We get inflation for February on Wednesday, GDP in the US on Thursday, with the annualized rate tipped to lift from 2.3 to 2.5%. Final check-in as to where we finished here. We saw a bit of selling into the close. The COB Australia Index off by up, I should say, by about 0.2%. I don't want to take anything away from this market when you consider what we've been through as of late. And when we look at the ASX 200, we've got it finishing at 7,932, up by 0.2% over the past 5 days. The index has gained 1.8%. However, down close to 3% in the last year to date. We also saw sector-wise consumer staples smashing it, killing it today, up by about 4% overall. The worst performer, though, the biggest weight on the market, was Infotech, off by 0.7%, following, I suppose, that sector lower in the US. All right, we hope everybody has a happy, healthy weekend. If you've missed anything this week, you can catch up online at ausbiz.com.au. We'll see you from 9:45 Monday.